guys, it's Kanisha, the Beauty CPA here. I am coming to you today to talk about retirement planning for beautypreneurs. So, we're going to specifically talk about tax saving retirement accounts for beautypreneurs. So, you don't want to miss this one. I know it's Friday. Happy Friday. This will not be long, I promise, but I did want to come up kind of as a follow-up broadcast to what we talked about on Wednesday with Ignatius CPA. Ignatius, who we went live on Facebook. We didn't have the opportunity to do it on Instagram, but I did post it so you guys could see that conversation. We talked about retirement accounts in general, just how beautypreneurs, you should be saving for your future self. I am coming to you today to talk about the tax implications of some retirement accounts that can save you money. Just as a reminder, for the last 3 weeks, if you've been rocking with me that long, we've been talking about tax planning and how we're going into, having a quarter left in the year. And you really want to take a look at your tax situation and see if you can save some money on taxes, because I'm going to tell you, as soon as 12/31 hits, it will not be much you can do to save on taxes. So while we still got time left in the year, we really want to address that, okay? So I want to say hello to those who are joining. As I go through this, please leave your comments and your questions in the comments. If you're watching on the replay, I promise I will get back to you. But it's Friday afternoon. I know it's nice here. I'm right outside of Chicago and it's nice. I'm not going to take up too much of your time. So I have 4 here, and I'm looking at my notes because I want to make sure I don't forget anything. I have 4 money saving retirement accounts I want you guys to be aware of. Do not feel like you have to pull out any notes. I'm going to make a post about this later. When you see it circulating, you just go ahead and save that for your reference. But I will put this out there in the post for you so you don't have to. You can kind of just stay with me in this conversation. So why are we talking about retirement accounts, in tax planning? Well, we talk about that because contributing to a retirement account, number one, the most important thing is that you're saving for your future self. We got to always keep that in mind, that, we're not going to be young, energetic, and vibrant forever. We're going to want to retire from the workforce. Even if we love what we do, we're going to want to retire someday, and kick back and enjoy, the rest of our years. So we have to save up money, right, to be able to sustain the same lifestyle, or even improve it. If you ask me, I want to improve mine. I want to be living the luxurious lifestyle when I'm, 65 and older. But while we're saving for ourselves, we can't save money on that, because you do get certain tax perks for contributing to, your retirement, either now or in the future. So let's get into that. The first plan I want to talk about is the SEP IRA. It's SEP-IRA. And the SEP part stands for Simplified Employee Pension Plan. Now, this is one of the simpler plans. You do not have to file like a certain tax return every year for this retirement plan. Contributions come from the employer only. So, you have your business. Even though you're the owner, the business is considered, the employer. But sole proprietors, single member LLCs, partnerships, corps, S corps, C corps, you all can have, a SEP IRA. Now it's only for you. It's only for you. And the good thing is you do not have to contribute every year. So let's say you're having a great year, so you're going to contribute, but then the following year, for whatever reason, you're not going to contribute. That's completely fine. It's easy peasy on that front. It has a very high contribution amount, right? So you can contribute up to $57,000 in 2020. And there's a little nuance to that, right? So you can contribute the lesser of 25% of your compensation, or $57,000. So one little trick I see people trying to play with that is, what happens is single member LLCs they will convert to an S corporation to kind of save on self-employment taxes, right? Then once they are the shareholder, owner slash employee, because you're supposed to be on payroll in an S corporation, they will then try to pay themselves as least amount possible because they're trying to save on self-employment tax. Well, that hurts you when it comes to retirement account for all you shareholder, owner employees. That hurts you because this here little nuance with the SEP IRA says you can contribute the lesser of $57,000 or what you're paying yourself. And if you are paying yourself very little to save on self-employment tax, that means you can't get the contribution for your retirement account. So just keep that in mind when you want to play these little games with how much you want to pay yourself to save on self-employment tax. There are other ways to mitigate self-employment tax. If you want to learn more about that, please feel free. Schedule some time with me. It's going to be the first link in my bio. But the little games you try to play with the S Corp, it hurts you in other ways, such as saving for retirement. The IRS, they know. They know. I used to work there. I worked there for many years, 8 years. I know that we know we're not just oblivious of the games. You know, it's all about if they're worth going after. It's not if we know. It's is the dollar amount worth going after. So don't ever think you're pulling like a fast one on the IRS. So that is the SEP IRA. The good thing about the SEP IRA though is, let's say you did not earn a lot, and so therefore your contribution is limited. You can stack that with the traditional IRA. And I think this year you can contribute $6,000. Keep in mind, these amounts I'm giving you change every year. So while this year it may be $57,000 for the SEP IRA and $6,000 for the traditional IRA, that's going to be different next year. They're going to change for inflation. Just keep that in mind, though. You can stack these accounts to save as much as you can and get a current deduction for it. And that's where the tax savings come in, because you're saving for your future self. So you don't have this money now. You're going to have it later when you're ready to retire from the workforce. And it lowers your income now to be taxed less. So it's a double whammy going on here. And that's the constant theme with retirement planning. I got a third one for you with the SEP. You get a tax credit for the retirement plans you put in place for your business. You get a credit for the amount that you spend to set these plans up. We talked about that last week when we talked about maximizing tax credits. So keep that in mind too. So you got 3 ways you could save for doing one thing that you should be doing anyway. You get 1, a deduction for contributing, a deduction for saving for your future self. 2, you can add that by opening a traditional IRA in addition to the SEP IRA. And then 3, you get a tax credit for setting up the plan. And remember, tax credits are better than deductions because they save you money dollar for dollar on your tax bill. Okay, let's get into the second one, the simple IRA. Simple actually does mean something. It's actually an acronym. It's the simplified, no, it's not the simplified. It's the savings incentive match plan for employees. I don't know why everything has to be an acronym, but it's an acronym. Okay, now with this one, the rules are a little more like hard and fast rules, okay? With this one, you must contribute annually. And if you have a team of people with you, if you have employees, so not independent contractors, but actual employees, you have to contribute for them as well. They have non-discrimination rules with the simple IRA, okay? So that matters. Because if you have a bad year, you still got to contribute. And you can't just save for yourself. You got to save for everybody. So if financially you don't think you're in that position, if you have a team or plan to have a team, then that may not be the route for you. Now, employees contribute up to, the amount is $13,500 this year. Employees. But the employee does not have to contribute. Employer does. So that means you, business owner, you have to contribute. And the way you contribute is you match dollar for dollar up to a certain percentage of your employee's compensation. That's how that works. I don't really like that one because you have to contribute every year. And it's non-discriminatory. Not that I want you to discriminate against any type of employee, but turnover in salons and spas can be often. And to have to deal with, I'm thinking about the administrative burden of it all. To have to deal with that administratively sounds like a nightmare. But, it's according to your goals and your dreams, okay? The third one we got here is the simple 401k. Now, that one is very simple to the one I just talked about, the simple IRA. They're like cousins. The biggest difference, though, is that you can take loans from the simple 401k. The simple IRA, you cannot. So let's say, for example, you choose the simple IRA route or the simple 401k route. No. You're thinking about the simple IRA, but you're like, man, what if I need the money? Everybody always talks about liquidity, right? How fast can it get the money out in case something happens? Like a pandemic. Go figure. Simple IRA, you could not have taken a loan out. Simple 401k, you can. That makes a difference. Because now you're more liquid. You have more access to your money in the case that you need it. All right. So the last one, and I like the last one. It only has one flaw. I like this last one. It's the solo 401k plan. Now, this is for the self-employed, owner-only business. Self-employed owner, solo meaning one participant, the owner. These are for those of you, if you have goals of having a workforce, W-2, this is not for you. But if you're managing that solo spa, salon, that studio suite life, this is for you, and I like it. Now I'll explain why. One, it has a very high contribution amount, the $57,000. That's a lot of money that you can save in a year, every year, while you're in business. To me, that exceeds any of the, the simple IRA, the simple 401k. If you're making enough, because with those you can save a lot, but you have to do a lot of stacking and like employer and employee matching, but with this one, the 57 grand is all in one. And I know you're probably thinking, well, that first one has the same limit. However, you can contribute 100% of your earned income with this last one, this solo 401k. Remember the other one, it was limited. $57,000, the lesser of $57,000 or 25% of owner compensation. With this one, you can contribute 100% of your earned income. So, it's not necessarily limited by how much you can make. The first one was 25% of what you made. This one, if you want to take your whole check, your whole salary, and give it to your retirement, you can. Which is awesome. Especially if you haven't been contributing, haven't been saving, and you just want to just go all in. This one is great. Another thing I like about this one is you can contribute from both sides. One side as the employer and one side as the employee. So it's kind of like, this one is like a great mashup of the SEP IRA and the simple plans, the simple IRA and the 401k. This is like a good mashup actually of the previous three ones, because you can contribute up to that really large $57,000 amount as the employer, but then you still have elective deferrals as the employee. So you really can stack these plans on top of each other to be able to save as much as possible. And that's what it's all about when it comes to tax savings. See everything that you qualify for. And if you can manage not to currently have that cash flow, we're not going to ignore that part. That's a real part. The cash flow, whether you need it or not. If you can part with the cash flow and contribute to the retirement savings account, not only are you saving for yourself, but then you're getting a current deduction now for your contribution. Not for just one account, but you can stack, say, some of these small business owner and the small business owner retirement accounts on top of some traditional IRAs. We haven't even talked about the Roth yet. Let's get into the Roth. Well, let me tell you my last downfall with the solo 401k is, well, my only downfall. Once what you have saved reached a certain amount. So let's say you've been doing, you're the bomb.com with saving for your future self. It reached $250,000. At that point, you have to start filing a separate tax return with the IRS to report it. It's called a Form 5500, and it's the form that you file for retirement accounts that has at least $250,000 in assets in it. That's my only thing with that, is that you got to start to pay, file some paperwork. You have to pay someone to do it. I do not recommend you try doing that yourself. Not that one. Maybe any other one, not the pension tax return form, the 5500. No way. So let's talk about the Roth. Now, some people don't talk about the Roth because you do not get a current tax deduction for the Roth. You don't. But that does not mean that it should be ignored at all in any way. Because although you don't get your tax deduction today for the Roth, what you put in there and any earnings that grows on top of that money is withdrawn tax-free. That matters because let's say you're just starting out your career. You're at a very low tax rate. But then you growing, you six-figure stylist, you're owning spas, owning salons. Maybe you hit 7 figures. You shooting for the moon. You're doing your thing. Now you're at this very high tax rate when you retire. Would you rather take the money out of your Roth, or would you rather contribute to a regular retirement account and get your deduction now and then have to take out your millions of dollars later when you're in a higher tax bracket and get taxed? Or the other way around? Would you rather put the money while you're in a low tax rate in a Roth now? Sure, you don't get the deduction, but your tax rate is lower. So any tax you have to pay won't be that much anyway. And then when your money grows and you're at this high tax rate later, you still get the withdrawal out tax-free. It dodges your 35%, 37, 39% tax rate even, because you put it in there 30 years ago because you were smart and you listened to the Beauty CPA. Now, a lot of people don't even consider the Roth because they don't get the contribution right now. But that will serve you great later if you're at a higher tax rate later. No one should be planning to be at a lower tax rate later, because your tax rate usually changes and grows with the money you are making. Usually. And you will be at a higher tax rate because you will be making lots more money. And you do not want to take your money out when you're at a high tax rate. You want to take it out tax-free because you got it taxed already, years ago, decades ago, when you were at a very low tax rate. So do not just discount the Roth, guys. That's the point I'm trying to make. Do not discount the Roth because you don't get the deduction right away. It's all about your goals and your plans, where you know you're going because you have been intentional and setting plans, and you're in complete control where you're going to end up. And if you know you're going to be at a higher tax rate, consider starting a Roth, especially now, because the Roth, you will your income will grow you out of being able to contribute to a Roth once you hit a certain dollar amount. And it's not that high. So start one now while you can, if you're not yet six figures, and contribute, max that out as much as you can. So you can be able to take that money out, let it grow tax free. I hope I didn't go too fast, but if you have any questions or comments, please leave them in the comments below. If you're watching as a replay, I will address them. It's Friday. I don't plan to keep you any longer. So next week, we're on the last step of this tax planning series, guys. We talked about the tax planning framework that I use to review your situation to see if you have any tax saving opportunities. I'll go through that briefly for those who are newer to this series. Step 1 is looking at your entity structure. Step 2 is accounting methods. Step 3 is maximizing tax deductions. Step 4, maximizing your tax credits. This week, we talked about step 5, retirement planning. And next week, we'll be talking about some advanced tax strategies and some loopholes. I'm going to give you my top 3 loopholes. They're going to be amazing. I'm going to give you my top 3 loopholes next week. And we're going to wrap this tax planning up. Guys, if you have not taken advantage of the free tax strategy session I'm offering you, that's going to be the first link on my bio. August is coming to a close. How many days we got left in August? 10 days? 10 days. After 10 days, my books are closed because I'm going into tax season again. The S Corporation filing deadline is September the 15th, and the extended 1040 deadline and C Corporation deadline is October the 15th. So we got 2 more tax return deadlines coming up. Again, S Corporation, general partnerships. That's going to be September 15th. C Corporations, Form 1040, that's October. I'm going into that season, and I know how that is. I'm going to be pretty busy. So for the next 10 days, I'm keeping my books open to do these tax strategy sessions. I want to look over your books and records. I want to look at your tax returns. I want to see and be able to tell you, hey, this is what I'm seeing. This is how much you're overpaying in taxes. And these are some things we can do to get you a lower tax bill for 2020. Take advantage of that free opportunity, because once August is over, my books are going to be closed for a little bit until after we get through these extended tax seasons. So please keep that in mind. Take advantage of that opportunity. Again, guys, have a great weekend. Thank you for joining me. Those who joined, feel free to leave any comments and I will get with you. Or if you're shy, feel free to shoot me a DM. I answer them as soon as I can. All right. So have a great weekend.